Hello and welcome everyone to our webinar, Swap Futures for Interest Rate Hedging, a new cost-effective tool. As a reminder, like all of our webinars, we're recording this webinar so you can access it by shooting someone on our team an email. And if you have any questions that we don't get to during the webinar, feel free to just follow up with a note and we'll make sure to get those answered. I'm joined by two fellow presenters today, Ted Carey from the CME and Craig Haymaker from Eris Futures. As a reminder, my name is Isaac Wheeler. I'm a managing director on our balance sheet strategy team here at Derivative Path. This is an exciting topic to talk about today. I mean, I think a lot of the innovation over the last few decades in derivatives markets and interest rate derivatives markets specifically has happened in the world of, how we book trades, how we manage trades, but there hasn't been a lot of innovation in the product itself. And so we're excited to get into swap futures specifically today for that reason. Maybe let's just start with some quick introductions. Ted, can you just give a quick background on yourself, the CME, and how Eris Futures fit into the CME's product group?
Absolutely. Thanks, Isaac. First of all, I just want to say I'm excited to be here today to partner closely with Derivative Path to discuss how interest rate futures can be used for hedging. By way of background, for those that don't know, CME Group is the world's largest derivatives exchange with products ranging from commodities like wheat, gold, and oil to equity indexes, as well as our fixed income complex. And in rates, CME is really the largest venue for U.S. interest rate risk management, with some of our leading products including Treasury futures and options, which trade over $800 billion a day in notional volume, as well as SOFR futures. And myself personally, I've been with the CME Rates Futures team for about 12 years now, working with asset managers, dealer banks, and other users to figure out how we can better serve their needs. And one of our approaches has been to offer a complete set of risk management tools, a one-stop shop for interest rate risk management. We've been expanding into new markets like mortgage-backed securities, corporate bonds, and among others. And one of our successful new products is this Eris SOFR contract that we're excited to talk about today. The Eris SOFR Swap Futures, as we're going to get into in more detail later on, is essentially a futurized version of an interest rate swap. So basically it provides identical exposure to swaps, but inside a futures wrapper. And it fits neatly into our liquidity pools alongside core products like the classic SOFR futures and our longer-term interest rate products like Treasury futures.
Great. Craig, how about yourself? Love a quick introduction on you and Eris Innovations.
Yeah, you bet. Thank you so much. Ted, thank you. Isaac, appreciate you having us on here today. Isaac and Ted have heard me say this before, but I'm something of a financial risk enthusiast trapped in a CPA's body. Came up through public accounting and have been helping organizations, manage financial products from an accounting and financial reporting standpoint, and also sort of a hedging framework standpoint, if you will. I've been with Eris Innovations for a year, but the company itself has been around since 2011. It was created by a handful of Chicago-based trading companies in the wake of the 08-09 financial crisis, and they really just wanted an easier way to trade swaps. So they filed a patent with the USPTO. It designed Eris SOFR Swap Futures. Interestingly, they initially launched the product and listed it on their own exchange, and then the CME came around in 2018 and said, hey, okay, why don't you let us handle the nitty-gritty of the exchange work, and you all can focus on marketing and education. So, we licensed the IP to the CME Group such that they list it for institutions to be able to trade it, to manage and mitigate interest rate risk. So, where does that leave Eris? So our role truly is to be a resource to end user financial institutions, right? Educate on the product, convey to institutions, what it is, how to deploy it for their own risk management purposes, and so on and so forth. So I've been helping institutions with financial risk management for around 15 years. So I was brought on, truly for this purpose, to be able to say, okay, here are some practical applications for swap futures, as well as some sort of technical guidance around how to operationalize it and also how to account for it, as you might imagine.
Yeah, and speaking as somebody that you've had to spend a lot of time educating over the last year, you guys do a great job of that. So
I appreciate
that. Yeah, so you've been at Eris for about a year. What has that experience been like? I mean, you talked about how Eris has been around for quite a while now, and this swap futures existed for some time. What's the journey been like over the last year? How have you seen that marketplace evolve?
Yeah, I mean, first of all, it's been wild. Over just the brief period that I've been with Eris and also been sort of engaging with folks like Ted at the CME. I mean, over that time span, open interest has increased more than 45%. Average daily volume has doubled. It's been really, really interesting to see sort of the marketplace's adoption of Eris SOFR Swap Futures for sort of the myriad of use cases that I'm sure we'll go over here. But it's just been a very interesting experience for me thus far. And honestly, I think it speaks to the power of CME's distribution, as well as sort of the resources and availability of folks to be able to be out there, sort of sitting down with institutions and end users and saying, okay, here's what it is and here's how to use it.
Great. That's really helpful. So let's maybe actually transition a little bit into just helping the audience understand, what are swap futures? I think Ted did a great job of kicking it off by saying, look, it's just futurized swaps, right? But how do these products work? What is the high level overview you can give the audience?
Yeah, absolutely, Isaac. As you said, it's a SOFR interest rate swap in a futures format. And one of the key innovations with this contract that makes it a little different than other interest rate futures and particularly effective here is that for the SOFR swap futures, in contrast to a lot of our popular and liquid products like Treasury futures, which are generally a front month contract that is rolled each quarter, swap futures work a little bit differently, where they can be held all the way to maturity without rolling. So, for example, you could put on a 5-year Eris SOFR contract today and hold it all the way through until maturity, 5 years forward, with the cash flows, i.e. the fixed and floating payments, basically getting accrued over that time each quarter. And this helps make it much more effective for hedge accounting applications. But some of the other aspects of swap futures, which are also similar to many other futures and options products, is that it is an exchange traded product. And what that comes with is a number of key benefits. First of all, there is price transparency, both pre-trade. You can see the bid and the offer on the screen, so you can see exactly what the bid and the ask looks like, as well as the sizes that are available. But also post-trade, the price and the quantity of the trades are visible as they occur. The contracts trade in increments of $100,000 notional, so very flexible in terms of managing position sizes. One contract is 100K. One of the key aspects that's made it particularly popular is that the margin requirements, so what CME has to collect as collateral, is roughly 50% of what an equivalent cleared swap is due to the standardized and liquid nature of these instruments. A couple other aspects related to that is the fact that futures contracts don't require individual ISDA agreements and bilateral dealer relationships. Anybody with a futures account can readily trade these. And in fact, more generally, they don't come with bank counterparty credit risk. CME is the central counterparty to every trade, the buyer to every seller, and the seller to every buyer. So we manage the counterparty credit risk centrally. I think that's most of the aspects. I guess one other thing to call out is that they're available in a variety of different tenors. We have them as short as 1 year and all the way out to 30-year. And we see many participants use a combination of different tenors to hit their different key rate durations and manage their interest rate risk.
Yeah, I thought that was aptly put, and maybe just to add or highlight a few things, emphasize a few things. With respect to the contract size, I think that speaks to the accessibility of the instrument. For institutions, just getting into mitigating interest rate risk with derivatives, it can be a really nice way to sort of dip your toes, wade into the waters. If you wanted to hedge a portfolio of 500,000 in principal, and trade 5 contracts of Eris SOFR Swap Futures, one could do that. So it really lends itself nicely to that aspect. Another thing I'll mention, and maybe this is more granular than we wanted to get into at this point, but I think about where mortgage rates are, and I think many practitioners and participants in the industry would say, they remain stubbornly high. Well, what if all of a sudden we woke up tomorrow and there's a significant rate rally, sort of universally, and all of a sudden we've got portfolios shrinking before our eyes. What's nice about Eris SOFR Swap Futures is it really lends itself nicely. I think trading on the exchange generally really lends itself nicely to rebalancing and adjusting your hedge position, right? Getting in and out of positions and doing that in a more dynamic fashion.
Yeah, no, I like that point, and I think you see that in the pipeline hedging world. I know we're going to talk about kind of who are the current users of futures products, but that is kind of an interesting distinction and a nice little niche that swap futures fill, right? I think on the OTC swap world, for ALM hedging, you see a lot of banks doing set and forget hedges. They don't hold them maybe quite to maturity, but they execute a trade. They keep it on for several years. But that structure isn't very compatible with constant rebalancing. Having to go and amend a bilateral trade or even a cleared swap constantly to rebalance the notional isn't the most pain-free process.
Right.
So I think that swap futures definitely have a role to play there. And then I think Ted, you made the point earlier, but I think it's worth reemphasizing just because I know I often get asked by clients, hey, can I use Treasury futures to manage ALM risk? And I know we're talking about swap futures here, but the often response I give with Treasury futures is that, well, you've got to roll that position. It's not the most hedge accounting compatible structure. I think one key distinction here is that yes, swap futures are futures, but a lot of the typical attributes and properties of a normal futures contract don't apply here. You don't have to roll the contract. As we'll get into, there's some these are very hedge accounting compatible. So we shouldn't mistake swap futures for some of those other futures products that exist out there that are more challenging to use for ALM purposes. I don't think that applies with swap futures. Maybe from there, let's get into the current landscape. So, Ted or Craig, I don't know whoever wants to take this one first, but who uses swap futures today, and why are they using them? How are they using them?
Yeah, maybe I'll start. Thanks, Isaac. So I would say swap futures have seen strong adoption from a variety of different interest rate hedgers, but some of the leading examples have been from mortgage companies hedging, as you said earlier, pipeline risk, as well as mortgage servicing rights, or MSR, fair value risk. So we've seen participation from originators, servicers, but also some of the investors in those assets, real estate investment trusts, variety of other types of accounts. I think one of the things that I would highlight, similar to what we talked about before, is the accessibility and the range too, right? So we've seen participants that are trading in the 500 million to billion type range of notional, as well as all the way down to, the 1 to 2 type million, given the flexible contract size.
Yeah, and I think I'll add to what Ted was saying, right? I think if we could distill it into 2 buckets, it's like, entities in the mortgage value chain, right? From originators to investors and everyone in between. And then really any entity with a funding and lending paradigm, have been really strong adopters of the product. Highlighting a few of these, for REITs, they really, really like the margin savings, which I'll dive into a little bit deeper later on. That's been sort of a meaningful value proposition for those entities, and just considering sort of the volume of the transactions and their exposure from an interest rate risk standpoint. We could sort of say it generically. It's really for any entity with interest rate risk exposure. Additionally, and in terms of use cases, what I'll highlight, loan investments awaiting securitization, yes, absolutely. But I would almost make it just sort of, more generic to, pipeline risk or pipeline hedging. I would say especially in the non-agency, non-qualifying mortgage space, is we're seeing a lot of ramp as well.
And why is that? So we showed that open interest slide early on. There's this ramp. what's changed? Eris futures have been around for a little while. I was probably asked by about Eris swap futures for the first time maybe 8 years ago. What's changed more recently to really increase this adoption with these users?
Yeah, I would say a number of things, but probably the most important is in the last 2 years, we've introduced something that we call portfolio margining at CME for the Eris contract, which basically recognizes the risk offsets that between people's positions in the Eris SOFR futures and OTC cleared swaps on the other side. And even if this doesn't apply to hedgers, one of the things that makes it particularly impactful in this case is for the liquidity providers that you're interacting with anonymously on our screens or in the block markets, is that those liquidity providers can trade a swap future on one side and then offload the risk with an OTC swap on the other. So they're, from an economics perspective, running a fully matched book. But before we introduced this portfolio margining concept, they would have to post margin for both of those contracts. And in some cases, therefore, for the entire life of the trade, say for 10 years or 30 years. So that cost of capital was significant. Now, with the recent introduction of portfolio margin, that can be netted down to really about only maybe 2 to 5% of what it otherwise would have been had we called for outright margin on both legs. So really what that means is that for the liquidity provider, swap futures are not a lot more easy to use. They can provide better liquidity, and that has made it more integrated with the broader OTC swap market. Craig, anything you would want to add to that?
Yeah, really, really well said, Ted. I think they got tighter and they got bigger, just generally speaking. I would even just say the extent of the conversations, the extent of the dialogue we're having on both sides of the market, right? So as you put it, Ted, right, the sort of the hedger side and the market making liquidity provider side. We're really talking often with all of these market participants, in terms of sort of how best to optimize the way that they think about Eris SOFR swap futures and the way that they trade swap futures, and how do they use it to sort of balance their own internal trading books and manage risk, right? So really just trying to stay close to all these folks. But the portfolio margining has been massive for this market specifically.
Yeah, and I've heard your colleague Craig before say, Jeff Sharp say, look, portfolio margining basically brings liquidity of the cleared swap space to this product, right? You can think of the two as interchangeable now because of this portfolio margining, and that I think is definitely big. And then I think maybe the last bullet here, and Craig would welcome your thoughts here as well, but it's hedge accounting support and comfort, right? So I think previously there's been, I wouldn't say that it was not compatible with hedge accounting, but we've definitely done a deep dive over the last year with your help in figuring out, all right, look, if someone does a futures, uses a swap future to hedge ALM risk, what does that look like from a hedge documentation standpoint? What unique features of swap futures need to be managed through hedge accounting? How do we account for them? And I think what we've come away with and recognized is that hedge accounting is fairly simple. A lot of the same typical ways that we would qualify a typical OTC swap for hedge accounting apply here as well, whether it's fair value or cash flow. And we've definitely gotten a lot more comfortable on our side with how does a fair value or cash flow hedge ultimately get documented for a swap futures trade. So that's I think been a development, maybe not just over the last year, over the last several years, but I think that's certainly going to support more adoption as we look forward to.
Yeah, I completely agree, Isaac. And you know me, I could talk about this topic for hours, if not days on end, if you let me. But I'll be kind to you all, and I'll be kind to our audience as well. We won't dive into debits and credits here now. But I think the way I'll add on to what you just said, I'll kind of blend the kind of first and third bullet points here in the bottom part of the slide. The transition from LIBOR to SOFR was meaningful for Eris. For a number of reasons, but I think the way I might characterize it is, kind of the ability to wrap one's arm around benchmark rate risk exposure just generally got easier with SOFR. When I think about 1-month term SOFR, 3-month term SOFR, both of those are derived from overnight compound SOFR, right? Whereas if I contrast that with the LIBOR environment, right, 1-month LIBOR, 3-month LIBOR, 6-month LIBOR, sort of the relationship and the behavior of those three discrete indices, it was prone to idiosyncrasies, right? And so in a sense, the transition to SOFR almost made, again, this notion of benchmark rate risk a bit more generic. And that was really, really beneficial for Eris SOFR Swap Futures. From a hedge accounting standpoint specifically, in applying these or designating these, right, as the term of art, I would say FASB has helped us to a degree, more broadly, right? For hedge accounting practitioners generally, I'm sure you would agree, and I'm sure your colleague Vaughn and his team would agree with that as well. Just in terms of, being, for example, better able to target a benchmark rate, a risk exposure, within sort of a fair value hedge accounting construct and partial term hedging, right? The general portfolio layer methodology, right? And when I think about the cash flow hedging side of things, sort of expanding the number, the different indices that we can now target, there's a better, smoother P&L outcome as a result of that. So when you sort of couple these things together and bring swap futures more into the fore, well, the transparent nature of the instrument really lends itself nicely to, the back end of hedging, right? The hedge accounting aspects, right? So there's greater transparency around the swap net present value for swap futures, right? Accrued interest, cash flows, all of that information is readily available and published to a public FTP. So, you couple, FASB changes, you couple general market, I would say adoption. I think the mini bank crisis, gave us some tailwinds in terms of, institutions really feeling the need not only to hedge, but also to apply hedge accounting. So I think taking all of these things into consideration has really helped sort of push swap futures into greater adoption as well.
Yeah, no, that's a great point. And I guess just to double click on that benchmark rate risk concept that you talked about, let's take an institution rolling FHLB advances or rolling fixed rate CDs and paying fixed against that, kind of creating, synthetic term funding with that strategy. Probably the most popular strategy, in recent years among regional community banks and credit unions. That's a trade that, when we had a term rate like LIBOR, it really felt like I needed the customization and the bespoke nature of an OTC swap because, hey, look, I'm going to borrow on the 15th every month. I need a 3-month rate that sets out of the 15th of every month. Now, we don't have a term rate anymore. And so everyone's had to get comfortable with daily, kind of using a daily resetting product to hedge term rate risk. And, well, if I'm now doing that with my swaps, all the advantages of swap futures, a lot of them are conferred by the fact that they're homogeneous, that everybody knows what the current on-the-run, 5-year SOFR swap future is. But you give up a little bit of customization there, but that's acceptable, I think, now that we've moved to this world of daily resetting rates. So I think that's a good practical example of maybe why that, isn't the obstacle it might have been if we were still in the LIBOR world.
That's right.
I guess maybe let's transition to, a couple, case studies just to put this in more practical terms for the audience. I think we've done a good job of, highlighting, the value proposition of futures. You guys have talked about the reduction in IM. I think that there's the potential, even as we'll get into, for, the reduction, or the increase rather in interest that I can earn on an initial margin, depending on the nature of my agreement with my FCM. And we talked about onboarding a little bit, but we'll drive home these points just through these two case studies. So maybe let's start with, an example with a large institution. And let's talk about, an institution that's over 10 billion and they've got a large portfolio of cleared swaps. Some of the advantages of moving to swap futures might be things like improved interest on initial margin. So not all banks out there earn interest on the initial margin that they post to the exchange through their FCM. So their FCM does not always pay them interest on that margin. And so if you move to swap futures, well, maybe we're getting set up. These are different FCMs a lot of the time. They might be the same in certain instances, but they could be different FCMs. And we often see that there's the potential to earn interest on that initial margin with swap futures. So maybe a little bit of pickup there from an interest income standpoint through the swap future product. The other one that's very large, and Craig, you talked about how this is important to REITs. You talked about how this is important to, I think all institutions really that are hedging, but specifically some of the users of swap futures today, is that there's a reduction in initial margin. You might be able to reduce the amount of initial margin you post to the exchange significantly if you're using swap futures to execute a hedging strategy, as opposed to OTC cleared swaps. There's also some simplified accounting here. So we often get questions from clients. We support all of our clients in hedge accounting, obviously, for these strategies. But there is a lot of different accounting that surrounds a derivative that might not be specifically related to hedge accounting, right? Hey, I'm earning not only interest on my swap because the dealer is paying me, or I'm earning interest on this cleared swap, but I've also got interest earned on margin. How do I account for that? Where do I account for that? Because swap futures have had to productize and kind of distill all the economics of an OTC swap into a single swap future, there's a little bit of simplification there, I think, as well. So that's a potential benefit. And then, lastly, from my standpoint, and I'll Craig and Ted, I'll have you expand on any of these points for this, potential large institution we're talking about. But in terms of go forward hedging activity, execution, I think the ability to just see quotes on a screen, that's something that certainly appeals to I think many out there. Obviously, I think post Dodd-Frank, even the OTC cleared and non-cleared swap world is still very transparent. I think we've seen execution costs improve in that world as well. But there's something about kind of listed liquidity that is a feature of this market that we don't see today in the OTC space. So I think that certainly could be a potential value proposition for larger institutions. Craig, maybe start with you. Anything you want to expand on there? For these prototypical large institutions with cleared swap portfolios already.
Yeah, absolutely. And maybe I'll sort of try to work my way backwards from where you took us, Isaac, if I can. Yeah, I mean, look, I like to think of swap futures for institutions as it's another tool in the tool belt, right? It's another option, another offering, to contemplate. You talked about interest on collateral. We think about sort of traditional, non-cleared OTC trades, right? We've got separate units of account for all of these things, that we need to contemplate when we're sort of operationalizing derivatives for hedging, right? We got to think about mark-to-market changes. We got to think about accrued interest and cash flows and all of those things, interest on collateral. Whereas with swap futures, it's one single unit of account, right? So that's a benefit. It's sort of streamlined to a degree. Efficient execution. Yeah, we have users referring to these as click-to-trade swaps, right? I think I alluded to this or highlighted it as sort of some of the impetus for the founding of Eris Innovations to begin with, right? As I think about use case, right? Like, let's contextualize this a little bit more. So let's assume we have, we'll take an easier example. We have a large institution with $1 billion notional in their portfolio, right? Let's say they're all 5 years. They're all cleared OTC swaps. They're likely paying roughly $32 million in margin, initial margin on those positions. Okay, if overnight they are able to substitute those positions for Eris SOFR Swap Futures, they'd be paying roughly $11 million in initial margin. So call it, roughly 64% savings from an initial margin standpoint. And then, you sort of riffed on this, so I'll try not to duplicate your words too much, Isaac. But, as we think about interest on that initial margin, that's meaningful as well. We have, interest-bearing or interest-earning collateral that has the potential to translate to, more of a capital benefit. So, a few sort of interesting points or aspects to the value proposition as it relates to large institutions.
Great. Thanks, Craig. Appreciate that. And let's now maybe talk about the other, I think, end of the market, the other end of the barbell, so to speak, where we think that, these products definitely have some value, and that would be smaller institutions. So let's imagine an institution, maybe even sub $1 billion. They haven't hedged previously. They're setting up a hedging program for the first time. We've certainly seen a lot of this, after kind of the 2023 banking crisis, as you shared as well, Craig. A lot of these institutions, in our experience, can have a little bit of difficulty in accessing bilateral markets. I think that the dealers that serve our clients in the OTC cleared swap space do a great job, but there aren't 20 of them, right? There aren't a dozen of them, even, especially for some of these smaller institutions. So what do you do when you have an institution that really needs to hedge? Maybe they even have a challenged capital and earnings position today because they haven't hedged previously. And that's kind of I think the cruel irony is that oftentimes the people that most need access to markets, that most need to hedge, that are very motivated to hedge, are also the institutions that aren't always the most attractive to bilateral counterparties from a credit standpoint. So, these institutions have difficulty accessing bilateral markets. I think Eris futures potentially have a role to play there as well. And so maybe I'll turn it to you, Craig, from there. Can you talk about maybe, or you as well, Ted, what Eris futures, how Eris futures can help solve the problem that those clients have today?
Yeah, maybe I'll start and then hand it over to Craig. I would just say, I think one of the things that makes it particularly attractive to smaller institutions is, again, the transparency and the independence of the contract. So basically, instead of getting relationships in place with a number of different dealers, you're connected to the entire exchange and the entire marketplace. And you can see the bid and the offers on the screen. Everybody gets the same price. We provide daily mark to market as an exchange based on those prices. So we're providing the daily close. A lot of those aspects, I think, make it particularly appealing to smaller institutions, that they can immediately achieve some of the scale in some cases that otherwise is only available to larger institutions. Craig, anything you'd add to that?
Really well said. I mean, look, it gives these smaller institutions access to the cleared markets, right? Sort of being able to play in the big pool, right? I think that's really poignant. The construct of Eris SOFR Swap Futures, as well as portfolio margining that Ted mentioned previously, again lends itself to liquidity. The standardization fundamentally of these products, concentrates liquidity. The bid ask is super tight. And if you do have a smaller institution, that maybe is able to get an ISDA off the ground with said dealer or dealers, their execution from a pricing standpoint may not be as tight. So swap futures offer a nice value proposition from that standpoint. I mean, look, as we think about operationalizing this, the simplification of it, the streamlining, we talked about single units of account, we talked about the accessibility of it. I mean, look, setting up a futures clearing agreement is far less in scope than putting an ISDA in place. Our futures clearing brokers are, the term of art in our world, in the exchange world, is futures commission merchants, or FCM, for those that aren't aware. They tell us that the onboarding time is, maybe 2 business days to 5 business days. So it's an expeditious process. You can get up and running quickly. You can almost be opportunistic about it if you'd like. So that's poignant. So what would this actually look like, right? Like if we use a case for a smaller institution, let's say they've got a $50 million exposure. Maybe we're really targeting sort of the borrowings, right, or variable rate funding aspects of the balance sheet, right? Could be advances, could be term deposits, whatever the case may be. What they would do is they would engage Isaac at Derivative Path, right, alongside their futures clearing broker, and they'd say, okay, I want to mitigate this risk by, synthetically locking in a rate or extending the duration on my funding sources. So what they do is they'd say, okay, I want to sell 500 contracts. Okay, when you sell Eris SOFR Swap Futures, you're effectively paying fixed and receiving overnight compound SOFR, and 500 contracts with each contract at 100,000 notional translates to 50 million. So that's what the process would look like. And it's kind of funny. Before I came to Eris, in a previous life with a previous employer, I helped institutions onboard Eris SOFR Swap Futures, for hedge accounting for this purpose. So, I could certainly speak firsthand to the benefits as well as, their appreciation, that institution's appreciation for being able to mitigate their risk using swap futures.
Yeah, I think that's a great anecdote, and I think your point about fast counterparty onboarding is a big one. I think that, especially actually in the credit union space, where a lot of those institutions have to have swap counsel review the documentation. It's not uncommon, and this, I think, even banks, onboarding can take some time, but credit unions specifically, we've seen, is the negotiations at the short end, a month or two, at the long end, especially if the institution gets distracted with other things, it can take 8, 9, 10 months, and the back and forth from a negotiation standpoint over those documents can take quite some time. So it definitely jumps out to me, and there's value in that, right? You see an opportunity, you think you need to hedge. Again, you're one of these institutions that desperately needs to mitigate rising rates risk. You've already seen margin compressed. Can you wait 2 months, 3 months to negotiate an ISDA with the dealer before you hedge? Not always. So I think there's.
Yeah, no, I completely agree with you. Sorry, I didn't mean to cut you off, but I've become increasingly self-righteous over the past year, and I think for some institutions it may be, an existential matter to be able to use derivatives to reduce their interest rate risk, and swap futures offer a good platform to do that. So, and look, as far as the, the onboarding, the ISDA negotiation process goes, right? Not picking on either side, right? Institutions, right? They have due process and they want to make sure they're making sound decisions with respect to the negotiation of those contracts. And on the dealer side, they could have a backlog as well. Any number of things can come up that sort of makes it a protracted experience. But for, a futures clearing agreement, what I've heard is on the very long end, it's maybe 2 weeks. Right, but the average is kind of that like 2 to 5 business day range. So, expedited process for sure.
Right. With that, we're going to bump up against time a little bit here. So we want to take some questions, give the audience a moment to submit those if they haven't already. So we'll just give it a second for those to roll in. One that's already popped up here. How, and I think you started to talk about this, Craig, so this might be some repeat information, but how do you do this? So an institution, say you want to get set up to do swap futures, how do they approach getting enabled, putting the tool in the toolkit, so to speak?
Yeah, no, that's a great question, and one we get often, right? Especially for the uninitiated and folks who aren't as familiar with operating on an exchange or through an exchange. So I guess first and foremost, Ted is not the person you call if you want to trade Eris SOFR Swap Futures. He and his team are happy to provide some education. We at Eris Innovations are also happy to do the same. But end users must engage a futures clearing broker, again, a futures commission merchant or FCM. Isaac, participants in FCMs in this industry, right? Derivative Path can help facilitate that connection as well. But users must go through a clearing member to be able to trade swap futures.
That's right. We also do have a list of both clearing members in general at CME, as well as a list of clearing members that are specifically have previously helped with Eris SOFR.
Yeah, and maybe I'll just add, just to be clear, right? That FCM is a fiduciary, acting and operating on behalf of the end user institution. That's an important point.
Great, that's helpful. And then, one question, Craig, and I think you could maybe expand on the example you gave before as well. But one question that's come in is, are other banks electing hedge accounting, presumably on Eris futures? I think the question is. Can you speak to that a little bit?
Yeah, you bet, Isaac. I mean, short answer, yes. And I can give a specific example. There's an institution in Texas, 500 million or so balance sheet that's using Eris SOFR Swap Futures to hedge fixed rate residential loan portfolio. They're doing it under kind of the fair value hedge accounting or portfolio layer methodology construct. That's how they're choosing to tackle that risk, right? And that requires, ongoing monitoring and operations and accounting associated with that. But that it's absolutely being applied in this context, right? We have other entities hedging, funding exposures using Eris SOFR Swap Futures as well. So certainly compatible and applicable for hedge accounting purposes.
Great. Well, with that, if we didn't get to your question, please shoot us a note. We're happy to answer over email afterwards. And as a reminder, this recording is going to be made available once we wrap up here. So please reach out if you want access to that recording as well. Thank you everyone for attending. Ted, Craig, thank you both for your participation. I think this is a great topic, one we'll hopefully be touching on in the future as well. And thank you everyone, and we'll see you next time.